Syed Nishat, thanks so much for joining me today.
Thank you, Chris, for having me again.
All right, let's get started. Can you talk about why tax planning is important for physicians, particularly this year?
Absolutely, Chris. Tax planning is very important for physicians, as you mentioned, specifically this year, because as you know that the Biden administration had just passed almost $3 trillion infrastructure bill. Now, whenever you pass in such an infrastructure bill, there usually is a budget deficit. And the big question people ask, what's the best way to pay for the bill? And most of the time, the simple answer boils down by raising the taxes. And if you can see in the Senate and the House, they're talking about different bills about wealth tax. But overall, the consensus is that people will be affected the most this year whose income is more than $400,000. Now, just to give you an idea, what's in the bill, let's say, for example, if your income is over $400,000, your top marginal tax rate goes up effective this year or whenever the law passed from 37% to almost 39.6%. Well, you can say, hey, it's not a big deal. It's almost only 2% jump. What's the big deal? The issue is, Chris, that any income you make more than $400,000, you have to pay additional 12.4% Social Security tax, which is actually a huge jump. And then most self-employed physicians, they do something called itemized deduction. If your income is more than $400,000, a provision in the bill is that the deduction start to phase out. Now, just in case, if your income is more than $1 million, any long-term capital gain, what I mean by long-term capital gain, that any stocks and mutual fund you own more than 1 year, now you pay only 20% tax, that goes up to almost 39.6%. So again, whenever the law passes, it will be retroactively that particular year, and everyone looks like this infrastructure bill has a bipartisan agreement. Most likely it will get passed. So that's why we are recommending all our physician clients to sit down with your CPA and financial advisor to do some advanced planning so they don't get affected when the law gets passed.
Okay, great for that. Thank you so much for that context. So let's talk about deductions now. What are the latest deductions that physicians should look for here before the end of 2021?
Yeah. So Chris, the best way to plan for tax planning, that to do something called advanced tax planning and try to incorporate that the tax law that was passed by the Trump administration since 2018, and make sure you don't miss the deduction. We always see that in tax filing, people miss out the deduction. That's the first step. One of the important deductions we see people miss all the time, especially physicians, is something called QBI. QBI stands for Qualified Business Income Deduction. If you're a self-employed physician, and let's say you derive $100,000 from your practice as a business income, you can write off 20% of this $100,000, which is $20,000, for example, as a deduction. A lot of times we see physicians say, hey, we don't qualify, we're a physician. No. If your income is below $315,000, you get the full QBI. So please make sure you speak to your CPA about the QBI deduction. Number two, there's a QBI for rental income as well. What I mean by that, let's say you have actively managed rental properties and you collect rent, you can write off 20% of the rent as a deduction as well. That's also we see physicians miss all the time. Third, just in case if you're thinking about buying a car or vehicle, this is a great year to do it because there's something called accelerated depreciation that was passed a few years ago. If a car weighs more than 6,000 pounds, if you buy the car before December and use it for business purpose, you can write off actually the full purchase price of the car. Usually these big cars are cost about $50,000 to $70,000, and you can get the write-off for the full amount of the car by using accelerated depreciation. So again, very powerful. Speak to your CPA about that. And again, another good deduction this year, like when you spend money for food from your corporation, usually you only get half of the deduction. This year, the deduction doubled, like dollar per dollar, almost 100%. I'm not suggesting that you have party every night to your corporation and spend money on food, but again, speak to your CPA. This is most likely the last year you can get 100% write-off of the food expenses you made for the corporation. And again, this is a good time to speak to your CPA. And just in case if you want to buy, let's say, equipments next year, buy this year. So you can do something called an itemized deduction, because most of the times we see that when the physicians sit down with the CPA, they do a standard deduction, which is $22,000. But if you have itemized deduction, if you do home improvements, those could be a part of itemized deduction. So you can go over the $22,000 limit. that the government has passed. Then, we all bought stock this year that probably went up. Physician like Tesla, people buy nowadays a lot, and they do something called charitable donation. A lot we see all the time. One of the mistakes we see that they just give out cash as a donation. Now, if you have appreciated stock, the best way to donate it is just give the appreciated stock as a donation. The beauty is, Chris, that in this way, that you don't pay any taxes on the gain, plus you get a deduction as well. So extremely powerful. Before December, try to open up a charitable trust on a donor fund and give the appreciated stock as a donation as well, so you can get a bigger write-off. Then, we all know possibly that we all have a federal tax, but we also have a state tax as well. The property and state tax, Chris, altogether, the maximum deduction is $10,000. I don't know if a lot of people see their taxes. It used to be like if you pay a property tax, you can get to write off all of it. But now the government capped it to only $10,000. States like New York, New Jersey, they passed a law. Rather than paying from individual, if you just pay for the corporation, the state tax, you can get to write off the full amount. So again, it's called state PTE law. Before December, you just have to elect it, pay the state tax from the corporation, and get the deduction as well. So extremely very powerful. Speak to your CPA about that as well, depending on the state you live in. And then if you have a lot of gain this year, speak to your financial advisor and try to look into something called opportunity zone. The good thing about, Chris, investing into opportunity zone, as long as you hold the property for more than 10 years, there's no capital gain taxes. So again, very powerful. This can be incorporated in your tax planning and overall financial planning as well. And then 5 to 9 contribution before December, whatever you contribute, you get to write off from the state tax. I have two sons. I can contribute for New York $10,000 for 2 kids, 7% rate for New York. Approximately, I can get write off almost $1,400 from the state tax as well. And lastly, I will just mention that if you have a lot of capital gain in particular stock, let's say you bought Apple, I'm just again giving an example, stock is up, or the stock is, let's say, for example, down, ideally, you book a loss into the stock and buy something similar, let's say Google, for example, but the benefit is going to be that the loss you can actually carry forward this year as well. So I know it's a long answer of a short question you ask, but these are the 10 deduction. I think the physician can sit down with your CPA and financial advisor, make sure they don't miss it.
Yeah, that's a great list. Thanks for sharing that. I think there's a lot of helpful stuff in there for the physicians. So obviously, retirement planning for physicians is vitally important for, just planning for the future of your family. But it's also obviously an important part of saving money in taxes. Can you explain some year-end retirement planning strategies that physicians can employ to kind of keep their tax bracket as low as possible?
This is a great segue, Chris, that once you actually have, max out all the deduction we spoke about, the next step will be less deferred money in taxes via retirement account. And retirement account is a great way to defer money in taxes because every $10,000 you contribute into retirement plan, if you're in a 35% tax bracket, we're looking for immediately tax savings of $3,500. There are different types of retirement account out there, but just to give you an idea how a cash balance plan works, if you're a self-employed physician, if you're 60, you can contribute into a cash balance plan almost $260,000. And this money, again, is completely tax deductible. But the way the cash balance works is an actual calculation based on the salary you take and based on your age. But so if your salary is low, the contribution goes down, salary is high, contribution goes up, but the salary must be adjusted by December. So don't wait until next year, do the adjustment this year so you can maximize your retirement account. That's number one, cash balance. But if you don't want to contribute this much money, one option could be you can do a SEP IRA, which is again 25% of your W-2 wage. But again, if the wage is down, SEP IRA goes down. So the wage needs to be adjusted by December as well. Straightforward IRA account, you have time for it. It doesn't have to be before December. You can do it by April of next year. And lastly, HSA account is extremely powerful, Chris. And we, as a physician, you take care of yourself. Very randomly, we see physician actually go to another physician. A mistake we see that they buy health insurance, they have the highest premium, lowest deductible, but it doesn't make sense. They don't go to physician. So the best way to do it is go for high deductible health insurance. The way it works, that the premium is low, but you can get to contribute almost $8,100 for the family for the year 2021. And after the age of 66, you can use the money for non-health reason as well. So again, HSA account is extremely powerful for the year 2021. Before the year ends, you have to change your health insurance to HSA account. So these are, I think, few of the things the self-employed physician can do it for their own practice.
You mentioned a lot of great tips for self-employed physicians. What about physicians who are working in a hospital or who don't own their own practice? They're a physician employee. What kind of options are available to them to help them with keep their taxes low and with retirement planning and things like that?
Yeah, great question, Chris. So for physicians who work for the hospital, one thing they can do is max out their 401k, 457, 403b plan. Again, over the age of 50, you can contribute $26,000 before December. So if you haven't done it, call your HR before December, subtract money from your paycheck. Another plan we see physicians miss all the time is a 409A plan, which is not common everywhere, but speak to your hospital whether they provide it. So you can contribute almost 80% of your income into this 409A plan, and this money is tax deductible. The problem is that if the hospital filed for bankruptcy, the money is not safe, like 457. So we're not suggesting put a lot of money, but it might be a good way to defer some money in taxes depending on your circumstances. And also, one of the things I just want to go back in Biden administration, one of the bills they have it is the Roth conversion might go away. This might be the last year, so self-employment physician or working for the hospital is a good idea before the year end to do some Roth conversion or backdoor Roth IRA, because, if this law passes, you may not be able to do it going forward. So yeah, again, these are some of the tips for physicians who are working for the hospital can implement for themselves.
Great. So let's wrap this up with let's talk a little bit about estate planning. Any year-end suggestions for physicians when it comes to their estate plans?
Yeah, so this whole bill we're talking about, there are two parts of it. One is the income tax. The second one is the estate tax, which is essentially a death tax. So right now, more than 22 million, there's no estate taxes. There's due, but the Biden administration and everyone is talking about wealth tax. So most likely it will come down to the overall census is between 12 to 15 million altogether. And it's not uncommon for physician, husband, wife, both working retirement age, they have this much accumulated net worth. This year, Chris, you can give away almost $22 million from your state. All money will after that grow estate tax free. Next year, if the law change, you may not be able to do it. So again, try to, this is not part of the whole, presentation today, but try to speak to your financial advisor whether doing some estate planning before the end of the year makes sense for your overall financial plan.
Any final thoughts, anything that we didn't discuss or anything you'd like to add to this before we go?
Yeah, I will just conclude, Chris. A lot of times we see nowadays, because of social media and obviously Reddit fueled, all people are nowadays focusing on buying stocks. They all talk about find me a financial advisor who can give you the best stock possible. I recommend that this is not what the financial advisor is supposed to do. Their responsibility is as a fiduciary to make sure your overall financial plan is in check. Because there is a statistic done, Chris, by PBS Frontline. Only 14% financial advisor meet the fiduciary standard. It's very easy to get calls from financial advisor to buy and sell stocks. So try not to get into it. Try to join a financial advisor. They talk about fiduciary financial advisor, fee-based, and they have the team of experts like lawyers, attorneys, actuaries. They can take care of all your financial advisor needs under one umbrella very efficiently.
Great. Syed Nishat of the Wall Street Alliance Group, thanks so much for joining us today. I really appreciate it.
Thank you.